Hello, market jobbers. Thanks for tuning in. I know we're called the stock market jobber, but we actually follow a lot of different markets. Stock jobber was actually a derogatory term by some, or considered by some back during the Revolutionary War, by people who didn't understand the way financial markets worked. Thomas Jefferson, James Madison, James Monroe, notable people. But regardless, back then, I guess they didn't have commodity jobbers. They probably did. They just didn't realize it. Anyway, we're just going to take a look at a couple commodities here because there's a couple lessons to be taught. So if you could just hang out for about 5 minutes, you're going to learn some valuable information that's going to help you make money down the road. Now, here we have our chart of oil futures. And I just want to point out one of the things we talk about a lot, and it's a lesson under the market principles page. But there are some price levels that are more important than others, and that's the case in pretty much any financial market that I've ever seen. Now, here's oil. Notice how this level here and this level here, right? I don't know what the exact level is. I think it's 92.70. But when the market rallied, what happened? It hit resistance at a former resistance level. For some reason, this level is resistance. Why is it not here? Why is it not here? I don't know. But the market always knows, and it tells us that that's resistance. So that's obviously a little bit out of play, but I just wanted to show it to you. Now, here's another market principle. Levels that were support can become support again, and levels that were support can become resistance. So why is this support? Well, market memory. I forget why it went down here. It was probably an overreaction, but there are people who wanted to buy it at this level that after we saw a rally, they were like, if it gets back down to here again around 82, I'm going to buy it. That looked like an important support level. And guess what? Those investors who wanted to buy, their orders converted this level into support. So then we rallied, we hit resistance, we come down. Where do we find support? A level that we had support at before. So investors look at the charts or use whatever analysis they use and say, hey, you know what? The last time we got to 76.50 was a good time to buy, so I'm going to put my buy order there. And 76.50 is obviously an important level. We saw a bounce and a rally. Now, where do we find resistance? Oh, look at that, 82, a level that was support. There are people who bought here who regret doing so. So after the, I'm sorry, let me say that again. I got it backwards. Actually, no, I don't have it backwards. There are people bought here who regret doing so after the market falls back below their price. And they tell themselves they're going to sell if they can at break even so they can get out of the trade without losing money. So they place their sell orders at the same level they had their buy order at. So levels that were support can turn into resistance. Now look at the more recent action we have here. The support level turned into resistance, but now it looks like we're breaking out here, breaking higher. And a breakout is when a price gets above an important level, and it's not just symbolic. It tells us that the investors who created the resistance have left the market. They either finish or cancel the orders. So my guess is we keep rallying a little bit higher here and run into resistance again around 82. So check in and subscribe to the site, and you'll learn how to make money with ETFs. You don't need to be a futures trader. It's important that these days you understand that you can pretty much profit off of anything in the market if you use ETFs the right way. And here we have cotton. Once again, we see that some levels are more important than others. And we could see back here, 88.50 was resistance. And when we got up to 88.50, it was resistance again. And it was again. This is called market memory. Maybe there's the same people that wanted to sell here, were patient when it went lower. Maybe there are investors who bought here who regret doing so, who tell themselves, I'm going to sell if I can get out at break even. Regardless, we don't need to know the reasons. We just need to know where the levels are. Not knowing where a price level is like driving around in a town you've never been in before without GPS or a map. You're not going to know where you're going. And we could see on the same thing on the downside here. 79 has been support. So this is what we call a rectangle pattern. And all it really is a trading range. You can see even if you dissect it farther, look at that. Support turned into resistance. This resistance over here. So this is our rectangle pattern. It's just a illustration of a trading range. All right, so just one more. This is sugar, and I think it does a really good job illustrating the concept of market memory. Now this is an 18-month chart. This black line is 2050. Look at how every time it got there, up until a few days ago, it hit resistance and went lower. Resistance is a large group of sellers. So for whatever reason, when markets are moving higher, it's because buyers can't find enough supply or sell orders to fill all the buy orders, so they have to pay higher prices. When the market gets to a resistance level, the tide kind of turns a little bit. There's enough supply or sell orders to fulfill all the demand. And a lot of times when resistance level gets to resistance and doesn't get through, the market sells off. And this happens because some of the traders look around and start thinking, gee, there's a lot of other sellers in the market here. That's why there's resistance. If I want to sell what I got to sell, my sugar contracts, I'm going to have to undercut the next person and be the lowest person in the market, or have the lowest price in the market, or the buyers are just going to go to where the best price is. So someone might say, you know what, I'm going to drop down to 2040. The next person might say, I'm going to drop down to 2030. And it creates a snowball effect. And again, you can see down here, I've explained support, but look at this clear support level here. Now, we got to resistance again. Now, this could be what we call a breakout. The sugar is trading above this level that's been important for the last 18 months. So what does this tell us? Well, it could tell us that the sellers who created the resistance or the supply with their sell orders have left the market. And that means there's a good chance it could keep trending higher. Now we'll have to see if does sugar come back a little bit, and does that former resistance level turn into a support level because remorseful sellers are trying to buy their contracts back. And if that happens, if we get a little bit of a trading range here, there's a good chance sugar will go higher. If not, it'll tell us that this is a false breakout and big moves lower tend to follow. So that's all I wanted to say. I know I said I'd only be a few minutes, and it's been 8 minutes, but anyway, I appreciate you checking in, and I will talk to you soon. Thanks for checking out with StockMarketDriver.com.